But what other kinds of emotional, kind of reactions do you see from people? What are they calling you about in a panic?
Yes. So I had one person, she called me when the stock was dropping like 80%. And people ask me all the time, what, and by the way, that was not my pick, just to be clear. That was not my pick. That was their pick on their own. Okay. So, but the stock dropped 80%. And then they're asking me, what do I need to do? Do I think I need to hold this to have the stock rebound? And I told them that you don't need to make your money back the same way you lost it. In other words, if it's a lousy company, and it's not a great investment, just go ahead and sell it and find a new one. So people are so hesitant to take a loss. They're so that's called loss aversion. They're so hesitant to, they always want to try to make the money back in the same way they lost it. So it's just important for people that what's happened in the past has already happened. And what you have to think about is going forward.
Hey there, and welcome to Money and You. I'm Michelle Perkins, your host. My search for more fulfilling work led me to career and business coaching, where I stumbled upon a game-changing discovery. Money issues often start with our mindset and habits. You see, our relationship with money is the key to overcoming those frustrating financial obstacles. As an entrepreneur, coach, and problem solver, I'm passionate about helping you create a great relationship with money. Because, turns out, that's the foundation for a limit-free life. Each week on Money and You, I speak with amazing guests about all things money, mindset, practical tips, and everything in between. We're here to give you new insights, education, and empowerment so money can be one of your favorite relationships. So join us for some lively conversations and let's transform your financial life together.
Hello, and welcome to another episode of the Money and You podcast. So happy to be here with you today. So happy to bring you a really wonderful guest. And we're going to talk about investments. We're going to talk about some of the psychological things that go on with money that, I love to talk about. So we're going to jump in very quickly here with today's guest. So I'm going to go ahead and give you a little intro into Earl Yaokasin. Earl is a CFO. He's the founder of Wealth Arch Investment Services in Pasadena, California, where he helps high net worth individuals and couples build wealth through value investing and personalized financial planning. With more than 2 decades of hands-on experience and a prestigious CFA designation, Earl blends the timeless principles of Warren Buffett with modern behavioral finance to help clients achieve financial independence. He invests his personal portfolio in exactly the same assets as his clients, reinforcing full alignment and transparency. Earl takes pride in offering advice free of commissions, sales quotas, or gimmicks. His firm is 100% fiduciary, and his focus is on long-term results, not short-term hype. Through education, clear planning, and thoughtful market navigation, Earl empowers his clients to avoid common financial traps, stay on course during turbulent times, and reach their goals with clarity and confidence. Earl, welcome.
Well, thank you, Michelle. It's an honor to be on your show.
I'm so happy that you're here. We had such a fun conversation a while ago, and I was looking so forward to having you on. So, I'd love for you to just to start by giving us a little background on what brought you to this particular career.
Yes. So when I was younger, one day I turned on the CNBC channel and then I saw these things going up and down and it interested me. It seemed like a game. I've always been great at games. And I also won a national math competition when I was in 7th grade. So numbers and strategy was always my interest. And then I tried every single thing I could come across. I read every single book in the libraries. I tried technical analysis. I tried fundamental analysis. I tried all of these things and basic charting, everything you can think of. And I figured out eventually it took me quite a while to find what suited me best. And here I am today helping other people invest their money in the stock market in a more safer and less volatile manner.
Mm-hmm. Thank you. That's great. I love that. I love even hearing about it because I get that. My sister's a mathematician. My daughter was so good at math. I mean, just from an early age, the teachers were asking her to help the other kids, and I was so excited. And I thought, she will go into something math oriented, but she didn't. So I feel like, and she loved games too. I think that's a clue. If you love games and puzzles and things like that, I think math is something that comes a little bit more easily to you, possibly. But yeah, okay, so that's great. And I'd love to know a little bit about your philosophy around investing, because I think it's a really valuable one that a lot of people can benefit from hearing.
So one of the most important investment principles that I use is called the margin of safety. In plain English, that's just like a buffer. So it's just like going to a mall. You're going shopping. You're trying to look for a nice dress. If you see something that's 50% off and it's selling for $50, that means it was worth $100 initially. And the same thing is true for stocks as well. If my valuation of a specific company is $100 and it's trading for $50, that difference is called the margin of safety or the buffer. And that helps investors protect themselves from losing money on a permanent basis. And the reason for that is because if, for example, that the competition comes up with a new product, then your valuation of 100 could drop down to $90. Let's say the CEO mismanaged a strategy, a product launch or something, then that $90 could drop to 80. Let's say I made a mistake in my own calculations. I was over optimistic about the company, that 80 drops to 70 and so on and so forth. So if my ending valuation after all of those unexpected negative events happen at the same time, drops my valuation from 100 to 70 and I bought it for $50, as long as the market's not panicking, eventually the $70 stock price will get hit and I will still make some money. And so that's how the margin of safety works extremely well in protecting downside.
Okay. Yeah. Thank you. And how does one, I mean, you're an expert in this, but how does the average person figure out what that margin of safety could be or should be?
Yeah. So in terms of the average person, you need to really delve into the financial statements to come up with an estimated value for the company. And it's really not for the average person to do. And so my advice for the average person is to simply try to take a look at what the market environment or what the participants or the mood of the market is. So Warren Buffett's famous saying is that when the market is greedy, be fearful. And when the market is fearful, be greedy. So just trying to get a sense and do the opposite of what everyone's doing. So by doing that, if everyone's excited, that means that stock prices are expensive and there's no margin of safety. There's no buffer. But if everyone's panicking and they're just selling stock prices, that means stock prices are depressed. And that means your buffer is so large. So that's one quick way for the average person to take advantage of the margin of safety concept without having to do complex math.
Mm-hmm. Oh, I love that. Thank you. That's a great answer. Okay, so let's talk a little about the psychological kind of aspects of money, because I love talking about that on the show. We do really dive into people's relationship with money. And, you're dealing with people and their money all the time. And so what are some of the things that you're seeing that both help people and also get in their way? I mean, it works both ways. It's not always a definite, but yeah.
Yes, definitely. And so let me take a step back and just answer the question from a bigger picture. So the first thing I wanted to say is that there are a lot of people that have access to the internet, have access to information that everybody else has. 40 years ago, people know stuff that other people didn't know. And so that's very different. And then the second thing is that there's so many smart people calculating intrinsic value, which we talked about earlier. So the real advantage for many people, including professionals and average investors, is to focus on the emotional, psychological aspects. That's where you can get an advantage against professional investors. And the best way to get an advantage is understanding 7 of the top investment biases out there. And the first one is herd mentality. So what that is just you're doing what everybody else is doing. So I mentioned earlier Warren Buffett's principle. So if you are buying when everyone's buying, you are buying at very expensive prices. When you're selling when everyone's panicking, you are selling at very cheap prices. So that is something you don't want to do. And by doing the opposite, that's how you can make money, the big money.
Love that.
And then the second one is called recency bias. So many people, in whether it's forecasting things in their personal life or things with their money, they think about what happened in the last month, what happened in the last year, and they think that's what's going to continue going forward. Mm-hmm. So for example, last year, the stock market was up more than 20%. And people are thinking, oh, I think the stock market's going to be up another 20% this year. But if you look at the longer term history of the markets, most of the time, markets are actually what is called mean reverting. In plain English, what that means is just it goes back to averages. It goes back to the averages. So if something is super high, stock price is super high, then eventually it will drop to where it should go. And when stock prices are super low, eventually it will go back up to where it should be in terms of the long-term averages. So what we want to make sure is we want to make sure that when we evaluate certain things, we want to take a look at a longer time frame.
Okay.
The third thing is confirmation bias. And what that is that, okay, I bought XYZ stock yesterday, and when I'm tracking or reevaluating my investment opinion of this company, I am going to look for people that agree with me. And when you do that, you feel good. It feels really good to have smart people agree with you. Mm-hmm. But the best advice that I have for your audience is to actually look for the opposite, which is you want to look for the people who disagree with you. So if you bought XYZ stock, you want to look for people that say, this is a bad investment because of number 1, number 2, and number 3. And then you want to think about, are those reasons valid? And then that way you can challenge your own position and just to make sure that your beliefs are actually correct. And it's not a one-time thing. You always want to be reevaluating your investments periodically. Mm-hmm. So that's the third one. The fourth one is called overconfidence. And so if we ask 100 people, are you an above average driver? 70 people will say yes, but there's no way 70 people are above average. So it's the same thing with investing. It's like, how good are you? When I talk to prospective clients, the first thing I ask them is, on a rating scale of 1 to 10, 1 being you don't know anything, 10 being you're an expert, where do you think you fall? And most of the times, especially males, they say 8 to 10 when they're really a 1 to 3. So, you know, there's a lot of ego involved there. So,
do you find the opposite with women, where they might go too low? Yeah. Yes. And actually in investing, that's a great thing. It's actually extremely important to be humble in investing. And the reason for that is if you're overconfident, then you're kind of having like blinders and not paying attention to the risks involved, and you think you're the best investor, everything you invest in will go up, but that's not true. Even the best investors in the world are batting approximately 60%. So in other words, if you're above 50% in terms of your batting average, you're considered a really good investor. And so that's just something to keep in mind. The other thing to keep in mind is that
in terms of this bias, if you're overconfident, if you make a lot of money in the very short term as a beginner, what's going to happen is you're going to risk more and more money. But if your results were more due to luck than skill, then you're going to get slammed at the end. It's kind of like going to a casino, winning for a month on the roulette table, and if you think, wow, I figured out a pattern. But in reality, there is no pattern to roulette. People have tried, unless you have like an earpiece or like an electronic device that can manipulate the roulette table spin. It's all just luck. And that's the danger of overconfidence, mistaking luck for skill.
Wow, those are great. That was really, really helpful. And very important things for people to hear and understand. So, we can understand some of those ideas and those concepts and the biases. But what do you see? I mean, those are also emotional, but what other kinds of emotional, kind of reactions do you see from people? What are they calling you about in a panic?
Yes. So I had one person, she called me when this stock was dropping like 80%. And people ask me all the time, and by the way, that was not my pick, just to be clear. That was not my pick. That was their pick on their own. Okay. So, but the stock dropped 80%, and then they're asking me, what do I need to do? Do I think I need to hold this to have the stock rebound? And I told them that you don't need to make your money back the same way you lost it. In other words, if it's a lousy company and it's not a great investment, just go ahead and sell it and find a new one. So people are so hesitant to take a loss. They're so that's called loss aversion. They're so hesitant to they always want to try to make the money back in the same way they lost it. So it's just important for people that what's happened in the past has already happened. And what you have to think about is going forward. And so that's something that I encounter, frequently.
Yeah, that's a great answer too, because we do have a tendency, when things are dropping to, even with real estate. I had a rental property that really tanked in, 2011 or whatever. And I found myself just sort of waiting for it to get back to a point where I could just pay my loan. And in hindsight, it wasn't the strategy I should have used at all. But it is interesting. Yeah, it's almost like a natural, let me see it get back to a certain point and then I'll sell it. And oftentimes that's not even what you want to do then. You want to get it to that point and let it, same with the rental property. I should have just kept it. It would have been, worth twice as much now. So it's interesting how reactive we get with these things, especially when we see them start to take a dive.
Yes.
Yeah. Yes. So, patience is a big part of it, I guess.
Absolutely.
But like you said, you also don't necessarily want to hang on to things just waiting. And that's a tricky decision-making process to navigate.
Yeah. If it's a lousy company with bad prospects, you definitely want to think about switching out.
Mm-hmm. Right. Because you're losing the opportunity cost of
opportunity cost. Yes.
Yeah. Yeah.
Absolutely.
Very, very interesting. And I love the, what you talked about, or what I mentioned in your bio, which was that whatever you're advising clients to do, you're doing yourself.
Yes.
And is that common in the industry? Is that what everybody's doing, or is that pretty unique?
No, it's actually pretty unique. And if you can believe it, about half of mutual fund managers have no money in their own fund. And this was a study done by Morningstar. And many people who obviously have even some money invested in whatever their clients are invested in are not 100% invested like I am. So my net worth outside of my emergency fund and my opportunity fund is exactly invested in the same investments as my clients are. And what that does is that it creates alignment. Mm-hmm. And so the most important thing for an investment advisor is to grow their clients' money, not to get more customers. And so by having 100% of my net worth, I am incentivized to make sure that the investments do really well, because if my clients lose money, I lose money. And if they make money, I make money. So it's extremely important. And that way, the client can really understand that whatever Earl is investing for us, it's in our best interest because he thinks this investment will grow. Unlike other advisors or other investment managers where they don't have skin in the game, then they have the tendency occasionally to recommend certain investments that just get a large commission.
Okay. And that speaks to being a fiduciary versus, I don't know what they call the opposite of that.
Selfish?
Yeah. I don't know. But
self-serving?
You do have to check, right?
Yeah.
Advisor or not. So yeah, that's all extremely important for people to understand when they sign on with someone.
Yes, absolutely.
Yeah. And how do you approach the planning process? So if somebody comes into your office and, wants to build their wealth, what are some of the other underlying questions that you're digging into to help them with that?
Yes, definitely. Retirement planning is one of the biggest things that my clients ask me and what I do for them. But the most important thing to consider is that there are so many financial planners that they build a plan, they come up with 100-page glossy, nice-looking, colorful packet that they hand out to customers. They charge thousands of dollars for. But the problem is that the execution of that plan many times is not done well. And so if they project, for example, on their plan to get 10% returns, they don't get 10% returns. Sometimes it's just 6%. So that plan is meaningless unless you can deliver on the actual returns. And so for me, the most important thing is about executing the investment strategy in order to get good returns. And then once the client's portfolio is already set up, then I do a financial plan, then we do financial projections. And what I recommend for professional advisors, as well as for those average investors who try to just Google retirement plan projections, is to come up with conservative assumptions. So similar to the margin of safety principle that we were talking about earlier, you want to have a buffer. So as an example, if you've been generating 10% returns on your money, just assume that you would get 8%. If you think that you are going to live until you're 80, think that you're going to live until you're 90. If you think that inflation is only going to run 3 to 4%, think about running it at 5%. So if you do these assumptions that are more conservative, if unexpected things happen, just like a buffer, like a margin of safety, you're still going to be okay. The last thing we want for anybody to do is to be working, for their clients to be working at Walmart when they're at 90. So that's the last thing we want. So you want to be conservative just to make sure that you don't retire too early. And you also want to, if you're still working, you want to save as much as possible in order to create that buffer.
Mm-hmm. Yeah, wonderful advice. And so are you investing in individual stocks as well as funds? Is it a mix, within people's portfolios that they're looking for?
Yeah, so my specialty is actually investing in individual stocks.
Yeah.
I do have a service that invests in funds, but that is not our primary service. The primary service is individual stocks. And the reason for that is that Warren Buffett said this, that if you know what you're doing, you don't want to be super diversified. You want to concentrate your ideas in your strongest conviction. So in other words, why invest in 100 stocks when you should invest in your top 10 ideas? But if you're not that good, or if you're not you don't know what you're doing, it's better to just diversify and invest in the S&P 500, invest in foreign index funds, things like that. And that way, no one single egg will destroy your nest egg. Yeah.
Very interesting. So you are kind of doing that hard work of figuring out what the best companies are to invest in, which I think, these days everybody's talking about, oh, don't bother to do that. You can't beat these funds. And so, and you know better than I do how that is for the general population. Maybe that's true in the general sense, but if you're knowledgeable enough and you enjoy it and you can figure it out, then you can do what you're doing, which I think is pretty great, especially in this day and age, because I do think the upside on certain specific companies is far greater. It's just, what are those, who are those companies? So, yeah, I think that's a little unique, but is it, or is that just my assumption?
No, you're correct. It's absolutely uncommon for advisors these days to invest in individual stocks. Mm-hmm. And I think it's an extremely important skill. So most people don't understand that sometimes large indexes like the S&P 500 could go on for many years without making money. In fact, if you invested in the S&P 500 in 1999, approximately, you wouldn't have made money for 10 years. That's an extremely long time, and people don't understand that. You mentioned earlier that when you invest in stocks, you can find really good ones that would go up in value significantly. But the converse is true too, where if you invest in the S&P 500, you're investing in the good, the bad, and the ugly, the overpriced and the underpriced. So if you know what you're doing, why not just stay away from those overvalued securities and focus on the ones that are undervalued? And that way you tilt the odds in your favor of making money. And so I do think that a lot more people should come back to studying how to invest in individual stocks.
Yeah, that's a really good point, because people, aren't necessarily learning those skills at this point. Yeah, interesting. You can kind of gloss over that, all that effort. I remember my dad poring over the charts that came in the mail. He loved the stuff that you love. And so he would spend hours in his study every night after dinner just going over these paper charts. But he enjoyed it. It was fun for him. So
yeah, it's absolutely fun for me too. It's just like a game.
Yeah.
And the beauty about investing in the stock market is that it's a game that pays you really well if you're good. So
yeah,
it's super fun.
What's since you've been doing this for a while, what's changed in recent times? Since the time you started, in terms of how you do this work. I mean, now we have AI, so I don't. Yeah. I'm assuming you're incorporating some of that into your analysis, but
yes, absolutely. So there are things that have changed and things that have not changed. But in terms to answer your question, I remember when I was starting doing this more than 20 years ago, I would have printouts of the annual reports and the proxy statements, and some of those are 300 pages long. And so I would read them cover to cover using, with those booklets. And so I'd have like a stack of stuff on my desk of stuff to read. And then eventually I can now download them, which is better, and it saves paper. So that's definitely has changed. And then with the advent of AI, like you mentioned, now instead of trying to find what page was that number on depreciation, I can just type in to ChatGPT or Grok or whatever you use, what was the depreciation for year 2019? And I don't have to find the 2019 annual report, things like that. It will just serve it up to me. So AI has made searching for information within those statements a lot easier. But at the same time, as we were talking about earlier in the meeting, with the advent of technology, always keep in mind that everyone has access to this. Yeah. So if everyone has access to this, that means the information that you think is special is not really that special. Mm-hmm. And in terms of what has not changed over the markets is that people continue to be emotional about their money and about investing. If things are going up, people pile on. If things are going down, people panic. And I don't think that's ever going to change, even with AI.
That's really interesting. That is so interesting. So what would you tell people, or what do you tell people about those feelings that they're having? Do you tell them just write it out? I mean, what is something that helps them to understand?
I would normally share this parable. Hopefully I don't butcher it. It's a Chinese parable. So there was this father who has a lot of horses. He's a farmer. He has a lot of horses. And then the horse ran away. And then the neighbor said, that's too bad. But the father said, maybe not. And then the horse came back 3 days later, bringing 5 horses. And then the neighbor said, "Oh, that's fantastic. That's great." And then the father said, maybe not. Then his son was riding the horse, and his son fell off the horse, broke his leg. Then the neighbor said, "Oh, that's terrible news." And the father said, maybe not. And then a few months later, there was a draft for the army. And then because his son's leg was injured, his son couldn't be drafted into the army. And then the neighbor said, "Oh, that's fantastic news. Maybe." And then obviously the father said, maybe not. And that story goes on, and that just tells you that in terms of life, if you think about your own lives, there's ups, there's downs. Nothing stays bad forever. Nothing good lasts forever, unfortunately, as well. And so just reflecting on your own life, reflecting on that parable, just understanding that this too shall pass. It's kind of like in the movie Lord of the Rings, there was Gandalf, and he had this staff, and he said, "This too shall pass," or something like that. So just always keeping that in mind, that whenever you feel an emotion, it's eventually going to pass. It's like if you meditate and you feel something itchy on your face, if you do nothing, it eventually just goes away by itself. So that's what I would recommend.
Oh, that's great. That was a great parable, a great advice. And I so agree with you. You really don't know. So when you see these isolated events happen, is it good? Is it bad? Well, it's going to feel a certain way, but ultimately, yeah, that's a really great way to look at it. Thank you for sharing that.
You're welcome.
So, there's a lot to talk about. Do you want to just comment on sort of today's world? And, because there's a lot of emotion in current times about everything economic right now and more than economic. But it is a funny, turbulent in some ways and mysterious in others. I mean, what I see is a little bit of a standstill, where there's a little bit of paralysis because we don't know where things are going or what's going to be happening. I see that especially in real estate right now, particularly because I have an investment property I've been trying to sell and didn't expect it to go quite like this. But what would you kind of say to people just, about today's world? And
so there's yes. So a great investor named Howard Marks, he always say, we can't predict the future, but we can understand where we're at currently and what has happened before. And so that's what we can do. So what people need to know is that the stock market has been on a 16-year bull run. It has been less volatile compared to historical standards. And the reason for that is there are 3 main reasons. The first reason is that interest rates were so low from 2009 to 2021. Mm-hmm. The second reason is that there was a lot of money printing by the Federal Reserve. And then the third reason, the government has been spending like a drunken sailor for many, many years. No matter Democrat or Republican, they've all been spending too much. So for example, during COVID, there's a lot of stimulus being done. Last year, as a percentage of GDP, the government spent 6.5% more of GDP, more than what they made. So that's extremely large. The only times we've seen that through history are during the recessions of 2008 and COVID 2020. So what that tells us is that the market has been on an upswing and people might be excessively greedy at this point. And so if we go back to what Warren Buffett was saying before, is that we want to be fearful when everyone's greedy. So I would just caution people that before they make an investment, and there are investments still today that are very attractive, but before they make an investment, just be on the conservative side before you actually hit that enter button on your trading machine.
Thank you. Yeah, very, very interesting and good advice. Are there any sectors right now that since you're looking at sort of more underperforming companies, as
Yes.
I'm hearing, what sectors are you particularly interested in?
Yes. So my favorite sector right now is what's unloved. That it's always been the case, and it's health insurance companies. So they've been battered really hard. So if you look at health insurance stocks, they're down 40, 50, 60% from their highs this year. And that's not insignificant. And there are many reasons why. One of the reasons why that they have been hammered is that the expenses that they're incurring are larger than what they expected. So in other words, people are going to the emergency room more, seeing doctors more, having procedures more than the historical averages.
Yeah.
And I do think that in the future, that the health insurance companies will be able to bounce back because every year they're able to reprice what they charge their customers, or what they charge the government, or what they charge corporations. So every year, whenever it hits like November 1st, I open up my health insurance statement. I mean, you're a business, so I'm a business. When I see how much my health insurance premiums increase, I curse. And it's really
Crazy.
it's crazy. And no matter who's president, Republican or Democrat, for decades, we haven't seen anything material change that. And I wish they would, but so far nothing has happened. And there have been some rumors here and there, or some hopes that the U.S. will transform to a universal healthcare policy like Canada. But just given how entrenched the tentacles of the health insurance industry is, I don't think that's going to change ever. And so because of that, I think the decline in the stock prices recently are a fantastic opportunity for your listeners to do some investigation. This is not financial advice, but do some investigation and make sure you think about the risk thoroughly. And of course, consult a professional advisor if you need to.
Wow, very interesting. Yeah, that's not what I expected. But thinking about it, that's super interesting. These are the kinds of things that I think would surprise me. So I think it would surprise people. And I think that's very cool that you're looking at those kinds of things. And maybe that's an incentive for other people also to think about that, to look for these areas that are, I mean, everybody's jumping on the bandwagon of
AI
and the
Yeah.
tech companies